I'm amazed because it is bone-crushing debt, and that's what we refer to it as. We're always looking for metaphors, and we run out of metaphors, actually. 318% of GDP globally. We're up 70 trillion in this cycle. We've really levered up during this expansion. At some point, we've got to service all this debt.
When this crisis hits, because it will hit, they'll say, you didn't warn us at the IIF, and CNBC, you were just cheerleaders for the market. You didn't warn us. Well, this is what we're trying to do now as well. Why is no one listening? And if some people are listening, and I know you speak to the IMF and all kinds of other people, are they listening?
The fund is, yes, indeed. But I travel around the world talking to fixed income traders, asset managers, and I talk mostly about the U.S., but globally, and you mentioned corporate debt in emerging markets, and no one seems to care. The U.S. physical trajectory is unsustainable. We're running trillion-dollar deficits. We're going to be at post-war highs very soon, and the markets have shrugged it off.
Of course, the raw number is important, but perhaps more important is the ability of the system to cope with this higher level of debt without some form of systemic crisis. Now, that was what the redrawing of the rules post the financial crisis was meant to do for us. Is the system robust enough to withstand another debt crisis?
I think the banking system is. We have more capital than we've ever had before. We've added $3 trillion in Tier 1 capital in this expansion. Balance sheets are bulletproof, as Jamie Dimon says. It's the sovereign piece that I worry about most. Can the U.S. in a downturn sustain deficits of this magnitude?
Well, of course, the US can always print money. Yeah. The problem in Europe is that specific countries in the Eurozone cannot print their own money. Should we be concerned that there may be a national crisis in Europe that the ECB and the Commission is unwilling to tackle by printing euros?
I doubt they'll print euros, but yes, there are some countries that have profound fiscal problems and are having a tough time because of politics dealing with them.
But your remedy is, oh, if you can print money, you're OK. My remedy is don't print money, don't increase the stock of global debt to 318% of GDP at an era where we've had record low interest rates, because there are various crises that can happen from all sides that will destroy the system. One, we can have a burst of inflation, which means people's rollover risk is enormous. Two, the US could be seen as a safe haven, which I was going to say a bad word there, which really hurts those EM issuers of corporate debt because, of course, they're issuing it in dollars as well. There are many ways this could go wrong. Printing money ain't the answer, Jeff.
Don't make me the bad guy in this. I'm just telling you what the reality is. Do you really think that anybody is going to take on board the facts that you've mentioned and begin to pay down the debt? The reality is, isn't it, that we are seeing our central banks preparing themselves for another round of support for this global economy. Do you think, as you look at Jay Powell now, do you think the Fed has actually blinked here and that the likelihood is we could actually see rate cuts rather than rate rises?
Well, we don't have a lot of room to cut. Real Fed funds is barely positive, and long-term yields are about 2.7%. So I think we're ill-prepared for the next turn in the cycle, both in terms of fiscal or monetary response. Maybe the worst prepared we've been in the post-war era.
What's the good news? No, I mean in all seriousness. I mean, I fascinate over this report, but is there anything good going on at the moment amidst all the doom and gloom?
Global labor markets are tight, including U.S. Wages are going up, so that's good for workers. Corporate profits are quite good. U.S. banking and other banking industry sectors are doing quite well. So there is some good news. People are making more money. People are going to work, and we can't ignore that.